Hey, good morning. This is Mayor Valensky with Driving Markets. So just a quick caveat as per usual. This is no investment advice. There's no financial advice here. It's only an opinion on financial markets and purely for media publication. So let's get going. So yesterday the big news was the Eurozone, the ECB, the European Central Bank raised rates by 75 basis points. Now I've been calling that for quite a while, that rates will go up by 75 basis points, but the consensus of opinion up until a few days ago by all the super analysts and the super bankers and the guys who are paid millions per year was maximum 50 basis points. Then all of a sudden they changed the tune and they changed it to 75 basis points, and that was a consensus of opinion, and that's exactly what happened. If you look at the week, we started off with the Reserve Bank of Australia raised rates by 50 basis points, okay? Then Canada raised rates, and now yesterday was the Eurozone, the ECB raised rates, and it's the highest rate rise since 1999. 75 basis points, which brings up to 1.25%, but historically rates are still very low and they're not high enough to combat inflation, nowhere near high enough, and therefore anyone says that we've come to the end of the interest rate cycle is simply doesn't know or is not telling the truth or don't know what the heck they're talking about. So what's likely to happen is you're going to see a far more aggressive interest rate rising over the next 12 to 18 months. Now the problem is that what you're likely to have is a battle between are they going to send the economies into recession, or are they going to make it a soft landing? Well, there's going to be no soft landing. It's going to be a harsh landing because the central banks are always behind the curve. What they do is they first of all loosen money, then they drive up inflation, then they tighten money, and then they drive up interest rates, then they loosen money, and they hopefully that will release the economy and make it grow. You see, that doesn't happen, grows too fast, then they tighten interest rates. So the central bankers are not the best indicator for where interest rates are going, simply because they're too far behind the curve. What you've got to look at the unusual or the extreme views in order to get an idea what's likely to happen with inflation and with interest rates. And one of those extreme views is driving markets. So one of the things I'll be saying to you is that inflation next year will be running at 20% and interest rates will be running at 6, 7, maybe 8% next year. That will have a major impact on property, a major impact on mortgages, which are already in the States at a 30-year high. No, sorry, at a 12-year high at 5.94%. So the 30-year mortgage is already running at 5.94% in the US. And what happens in the US happens in the rest of the world. So you're going to see mortgages and interest rates rise in the rest of the mortgage rates rise in the rest of the global economies like Europe, like the UK, Canada, America, etc. And that will have a major impact on property prices. Look at some asset classes, all the high-risk asset classes, whether in the NASDAQ, where they're talking about the Apples, the Amazons, the Googles, the Metas, Facebooks, etc. They're all going to be Netflix. They're going to be hammered by higher interest rates, by rising interest rates. So that's what you've got to be aware of, okay? Furthermore, you're going to have Bitcoin going down from 19,500 down to about 18 and then down to 15,000. You've got a strong dollar. The pound is likely to go up further. I reckon the pound's going to have a massive bounce. It's been oversold. And I've got to mention the Queen. I love the Queen, and it's very sad, but she was 96 years old. Let's see what King Charles will do, and we'll move on from there. This is Mayor Valensky with Driving Markets. Have a good day.